Right. Luis is going to speak.
Okay, we are live now, right?
Yes.
Right, Luis.
So we have 30 participants right now. If you want, we can give them 4 minutes so we can start sharp on 6:05 Brazilian time, 3:05 Mexico time. Is that okay with you?
No problem, Luis.
Okay.
Right.
Hello, Omar. I can see you now, but you are upside down for some reason. Okay, so it's 3:04. Let's give a couple of seconds and we'll start. Okay, 3:05. I think it's time to start. So welcome everybody. Some housekeeping items before we start. The session will be recorded. We are now live in YouTube also. Please make sure to keep your microphones on mute if you're not speaking. We have a packed session today. We're very happy to have a joint session with the Brazilian and Mexico gene. We're going to have 3 different panels. So we're really going to have an overview of different subjects. They're going to be quite a speed panels. And we're going to have a Q&A of about 5 to 7 minutes after each panel. So please be sure to participate. We want to make this session as dynamic as possible. So before we start with the panels, let me share my screen. We have with us different authorities from Ifa, which I want to introduce, and they'll take a couple of minutes on sharing I'm sharing some words. Can you see my screen now?
Yes, we do.
Okay, so I'll first start with Gustavo Brigacao, who is the president of Ifa Brazil. Please go ahead, Gustavo.
Thank you, Luis. It's a pleasure to have you here. And this evening, Ifa Brazil and Ifa Mexico will host a very, very special event. It will be just this joint meeting of the in-branches of Mexico and Brazil. I hope it to be the first one of many. This meeting will deal with current topics in international taxation in these two countries. And this is a very, very special opportunity for all of us to learn with each other and to create tremendous networking between tax professionals between these two branches. This is also a great opportunity for us to see our friends from Mexico, which we were planning to do during the Ifa Congress that was planned to take place in the second semester, but had to be canceled because of this terrible pandemic coronavirus. But I've just been informed that in 2022, we'll have the pleasure to see you all in Cancun. We are looking forward to this very much, and it will be a very good opportunity for us to celebrate life and to celebrate the hill for all this illness that we are having to face nowadays. As we said, we have these three panels, and the subjects are very interesting: Mexican Brazilian tax treatment and interest, royalties and technical services, Mexican Brazilian CFC rules versus Article 7 of the DTC, and Mexican Brazilian tax treatment of capital gains. Very, very, very interesting subjects that will be dealt with by our friends. I wish you all a very interesting event tonight, and say again that I'm very happy for this to happen, and I just wanted to be the first of many others. Thank you, Luis.
Thank you, Gustavo. I'll pass now to Claudia Sutter. Claudia is the chair of the GIN worldwide. Thank you, Claudia, for being with us today.
Thank you a lot, Luis, and it's, as usual, a great pleasure to attend these YIN seminars that you are organizing. It's really fascinating, and it's always a pleasure to stay up very long and very late in my office, you know, to enjoy what you're presenting and organizing. I think you're a great role model in engaging between the YIN branches across the globe, and even more so during this pandemic. And really, congratulations on all your achievements.
Thank you, Claudia. And then, we have Omar Zúñiga, Secretary of Ifa Mexico. Thank you, Omar, for being with us.
No, thank you, Luis, and congratulations for the joint panel that you're organizing. Congratulations to Mariana, to you, and to all YIN branch of Ifa Mexico and Ifa Brazil. We have always considered that YIN is very innovative, and I think this panel is proof of that. It looks very interesting, and I guess that throughout this time, one of the good things that came out of the pandemics is our ability to organize seminars remotely and have everyone participate. And even though the distance is there, that we can connect and interact with this very interesting subject. Be mindful that unfortunately, given the pandemic, we were not able to organize our seminar Cancun, Mexico 2020. As you know, this was postponed to 2022, but hopefully next year this issue will go away and allow us to return to our normal activity. And we welcome you for the Cancun 2022 now event. Looking forward really to see you in the beautiful beach of Cancun, and it should be a great event. We'll be very happy to see you there. Thank you, Luis. Thank you, Mariana, and enjoy your session.
Thank you, Omar. Mariana is the chair of GIN Mexico.
Thank you, Luis. And I have to say, this has been this seminar that we are now having is a proof of a great effort between the two GIN branches, GIN Mexico and GIN Brazil. We are very we at the GIN Mexico branch are very happy to be able to interact with GIN Brazil branch. I have to say that that as Omar was mentioning, and also Gustavo, one of the good things that at least we have with this pandemic is that we have been able during this year to organize sessions where we have had the opportunity of interacting with our friends and colleagues from many other countries. And this session is now a proof of that. We have also been fortunate to organize other meetings with other GIN branches as GIN Colombia, GIN Peru, GIN US, and GIN Canada. And of course, Brazil couldn't be forgotten. We have a strong links with Brazil. We are brother and sister countries, and we welcome you to this event. Thank you very much, and I'm sure you will enjoy these three panels that we have put together today for all of you guys. Thank you.
Thank you, Mariana. Eduardo is the chair of GIN Brazil. Eduardo is.
Well, hi everyone. Thank you, Luis. I'm truly glad to be here today, even in this crazy pandemic times. With the technology, with our work, we could put all these good people together to speak a little bit about international taxation, the interaction between Brazil and Mexico. This was really nice. And of course, this wouldn't be possible without the full support of Mexican and Brazilian branch. So I also take this opportunity to greet our president, our directors, and also the president and directors of Mexican branch for all their support. I also take this opportunity to wish you all a very successful Congress in 2022. It was really a problem to cancel this year, but I'm sure it will be better and better in 2022. From our perspective, from Brazilian YIN perspective, we have been working very, very hard during the past 5 years to structure our local YIN branch, our local activities, and Mexican branch and its organization were always kind of a model for us. So I also thank you for the inspiration. And without any further delay, I will pass on the word for our stars of today so that we can discuss those interesting topics on international taxation. And probably today we will know a little bit on how Brazilian tax authorities interpret tax treaties, which is always something amazing. Thank you.
Thank you, Eduardo. So just last thing before we start with the panels, we're going to project a quick 1-minute video, bear with us, about the IFA Congress of 2022 in Mexico. So give me just 1 second to do that.
Dear IFA friends, my name is Edgar Anaya, proud president of the 75th Congress of IFA. And today I'm here to invite you to plan ahead your visit to the Mayan Riviera in the fall of 2022. In less than 2 years, Mexico will host a wonderful and unique Congress for us to show the IFA community the best of the Mexican culture, our rich history and traditions, and our passion for hospitality. The technical sessions have been tailored with truly interesting scientific topics that will certainly be of significance to the international community. All of our sponsors that were ready to celebrate IFA in 2020 and that are joining us in 2022, a special thank you for your trust and commitment. Today the world has changed, but we will recover and come out stronger. We all want to travel, see our IFA friends, and celebrate a bright new tomorrow. But for now, stay safe. On behalf of IFA Mexico, our best wishes in these uncertain times. And see you in September 2022 in Cancun, Mexico. Stronger than ever.
Thank you. Now we'll start with the presentations. Just give me 1 second, please. Okay. Okay, so for the first panel, we have, it's entitled Mexican Brazilian Tax Treatment of Interest, Royalties, and Technical Services. Our panelists are Ana Elena Dominguez. She's a tax associate at Manuel Tron. She has an LLM in International Taxation by Vienna University of Economics and Business and Masters in Mexican Tax Law by Universidad Panamericana. Her practice primarily involves the design of structures for cross-border investment, both from abroad to Mexico and from Mexico internationally. She's an active member of the GIN and WIN committees of IFA, and she's an author of The Need for Arbitration in Tax Treaties of the book OECD Arbitration in Tax Treaty, published by Linde. And Francisco Lisboa has an LLM in International Taxation at NYU, and it's a PhD candidate in tax law at Universidad Sao Paulo. And he's a partner at Bocater Abogados. Please, Francisco and Elena, go ahead and start.
Thank you, Luis, and thank you to everyone who are joining us today. As Liz said, Francisco and I will discuss the Brazilian tax treatment of interest, royalties, and technical services. And first of all, we deem it necessary in order to understand what does interest mean under both Mexican and Brazilian legislation. We need to understand what does interest mean. Interest, regardless of the name used, refers to yields on credits of any kind. In addition, the Mexican rules applicable to foreign
I think we're losing you, Ana Elena. You're in mute right now. You're in mute.
Now
Yeah.
everyone is listening to me?
Yeah.
I'm sorry, this, yeah. As I was saying, we were going to talk about the interest. As a first topic, we're going to talk about the interest and what does interest mean under the Mexican tax legislation. Interest, regardless of the name used, refers to yields on credit of any kind. And in addition, the Mexican rules applicable to foreign tax residents deems as interest the credit returns of any kind, whatsoever with returns of public debt, bonds or obligations, bonds or debentures of the
I think we're losing Ana Elena. Francisco, why don't you go ahead and start with the Brazilian part of the presentation, and then once Ana Elena solves her issue, we can go ahead and start with Mexico.
Yes, sure. Do you hear me well?
Turn off my video. Maybe do you hear me here now?
Yes,
No,
yes.
You hear you well.
I will turn my video because I think I have a very poor connection. I was saying that regardless of the name used, yields on credits of any kind shall be deemed as interest, as well as those credit returns on any kind. The profit arising from the alienation made by a resident abroad from loans payable and acquired by a resident in Mexico or a resident abroad with a PE shall also be deemed as interest. And the disposal made by a resident abroad from loans payable by a resident in Mexico or a resident abroad with a PE in the country when they are acquired by a resident in Mexico or a resident abroad with a PE.
Do you hear me
now,
well?
Francisco, if you want.
Yes, yes. So what I wanted to discuss here is that under Brazilian tax law, we have a relatively similar concept. The point here that I wanted to clarify is that Brazilian tax authorities had always attempted to collect the withholding tax on interests whenever they had the concepts of credits, remittance, or even the accounting entry regarding the obligation within the debtor. But recently, there was a Superior Court of Justice decision which clarified that the triggering event for the withholding tax was always whether the due date or the payment occurred, whichever happens first.
Being said that, if Luis, the following slide, please. This is very relevant in order to determine the scope of the term of interest on the treaty provisions, where the Mexican and Brazilian DTC states that the term of interest comprises income from debt claims of every kind, whether or not secured by mortgage, and whether or not carrying a right to participate in the debtor's profits, and in particular, income from government securities and income from bonds or debentures and any other form of indebtedness, and also assimilated to income from money lent according to the domestic legislation. Here it's important to note that according to the protocol, Article 4, any interest paid as consideration of the invested capital which are deductible in Brazil in connection with the Brazilian law will also be deemed as interest. Now, we deem it necessary in order to clarify which are the withholding tax rates applicable to the payments of interest made for at least in Mexico, for foreign tax residents who derives income from Mexican source of wealth. It is to say when the capital is placed or invested in Mexico, or when the interest is paid by a Mexican resident or a foreign resident with a PE. And in those cases, the payment of interest will be subject to the following withholding tax rates. I think we're in the next slide, Luis. Thank you. First of all, we will have a 4.9 withholding tax paid to the financial system. And specifically, the law states that up to 4.9% on the interest paid to resident abroad arising from credit instruments placed among the investors referred as interest under the Mexican income tax law, the earning certificates, credits by credit institutions, those placed through banks or brokerage firms resident in a country with which Mexico has signed a tax treaty if there is compliance with information requirements established in the general rules issued by the Mexican tax authorities. And also this 4.9% will be applicable to interest payments made to foreign financial institutions in which the Mexican federal government of the Mexican Central Bank has equity participation. In second place, we have a 10% withholding tax on interest payments made to, among others, non-resident banks upon compliance with disclosure requirements, a 50% to interest payments made to insurance companies and financial leasing, 21% on interest payments made by Mexican credit institutions to creditors different from those appointed above. 35% withholding tax rate is applicable to interest when the direct or indirect beneficiaries of the interest, either individually or jointly with related parties, receive more than the 5% on the net interest arising from the instruments in question and are either 1, holders of more than 10% of the voting shares, or 2, business entities holding more than 20% of the shares. Under the Mexican tax, income tax law, we have certain cases where the payment of interest will be tax exempted, in which this is the case where the payment of interest derives from loans to the federal government, or from loans for 3 or more years granted or warranted by duly registered financial entities, and those related to loans derived from bonds issued by the federal government or the Bank of Mexico. Now, Francisco, you can go. Yeah.
Oh, okay. So on the Brazilian side, our rates, they are very straightforward. We need to keep in mind that for fixed income investments, We have under the Brazilian legislation the equalization to the same treatment due for Brazilian residents. So for interests, it's going to be a 15% rate. Other types of operations, basically they would fall under Article 744 of the income tax regulations, and 15% rates applicable when the beneficiary or is resident or domiciled abroad. For public bonds, we have a specific reduction to 0% in some situations, except when the beneficiary would be resident or domiciled overseas, and except in the cases of tax havens or domiciled in countries that do not tax or tax income in rates below 20%, which is our definition for tax havens.
And now, under the provisions agreed under the Mexican and Brazilian tax treaty, the allocation rights given has been given to both the residents and the source states. And specifically, Article 11, paragraph 2 states that payment of interest shall be subject to tax by the states where the interest arises, up to a 15% withholding tax. However, it can be reduced up to a minimum amount of 4.9, which is the minimum amount established under the Mexican tax law. And this provision is stated through Article 5 of the protocol. And also the withholding tax is important to know that it will be on the gross amount of the payment. Can we go to the following slide, please? Here, I would like to know that it is very important to consider what is provided under Article 11, paragraph 3, which provides two main tax benefits in connection with interest. And here in particular, for me at least, was very surprising when I was reading this provision, because I think Mexico only has this kind of provisions with the Brazilian tax treaty, which states that there will be a tax exemption, whether or not the taxpayer is a resident of Mexico or abroad, if the interest is paid to the government, its political subdivision, or to its central bank, or any other financial institution owned exclusively by the government or by its political subdivisions. And here, that's like the main matter, is that here Mexico has waived its taxation rights on the income, even though such income is earned by a tax Mexican resident. Item B under this provision states that also it will be the taxation only at the resident state if interest derives from public debts, bonds, or debentures issued by the government, its political subdivision, or its central bank. And here, as a way of example, I would like to say that, for example, if we have a Mexican tax resident who acquires and gets paid interest from Brazilian bonds, these bonds will only be taxed under the Brazilian law, if it's applicable, and shall not be taxed under the Mexican income tax law. Other provisions, or like the other paragraphs of Article 11 states that Article 11 shall not apply if the effective beneficiary of the interest, being a tax resident of one contracting state, has in the other state a PE or carries on business operations in Mexico. Go to the next slide, please. And now we would like to explain a little bit, and in order to understand how is the tax treatment under both legislations. The interest payment deductions, as a general rule, Mexican taxpayers are entitled to deduct the payments of interest, and specific provisions related to the calculation of deductions for interest payments and for the accumulation of interest profits to be taxed are considered. These calculations of the deductions shall be made on an accrual basis with no adjustment for inflation, and after the appropriate calculations are made, the taxpayer may be entitled to accrue the inflationary gains or deduct inflationary losses. In the next slide, it's important to note that under the Mexican tax law, two specific anti-avoidance rules has been introduced, and which states that interest payments related to back-to-back loans between the related parties shall be considered as dividends, and as the well-known thin capitalization rules, those interests paid from one related party to another on a loan from non-resident related party are non-deductible for income tax purposes to the extent that the debt-to-equity ratio of the payer company exceeds 3:1. It's important to note that Mexico considers that these thin capitalization rules will not be applicable to those debts incurred for the construction, operation, or maintenance of productive infrastructure linked to strategic areas or generation of electricity. And the next slide. Starting from January of this year, Mexico introduced an interest deductibility limitation by means of which, following in the line of the final report of Action 4 of the BEPS project, the net interest expense exceeding the 30% of the adjusted taxable income for the fiscal year will be not deductible in all cases in which the interest accrued during the year deriving from its debts exceeds 20 million Mexican pesos. This rule applies jointly with the legal entities or permanent establishments belonging to a same group or which are related parties, where the calculation will be made on a group basis pursuant to tax regulations. And the next slide, we have that this limitation applies if non-deductible interest calculated under the new rules is greater than those calculated under the thin capitalization rules. In this regard, tax provisions provides that the adjusted tax profit will be determined even if there is no tax profit or when a tax loss is generated during the year. In the case where a Mexican tax resident has a tax loss, the amount of this tax loss will be subtracted from the concepts indicated, and when the amount of the adjusted tax profit is 0 or a negative number, the deduction of the totality of the interest payable by the taxpayer will be denied. Finally, the amount of the adjusted tax profit at the income from interest with a foreign source of wealth in Mexico will only be included in these concepts in the same payable proportion of the income tax after deducting the foreign income tax which has been credited and paid abroad. And this net interest expense is similar to the concept of EBITDA, that is earnings before interest, taxes, depreciations, and amortizations. So I think Mexico here follows, and in compliance with the recommendations of the OECD, has considered that the non-deductibility of interest shall be considering which are the real income of the taxpayers. This rule is in the following slide, please. This consideration from the acceptance of a warrantor will not be considered as interest, except when related to an instrument which yield is considered interest, and the net interest, which is not deductible under this provision in one tax year, may be deducted in the following 10 years, similar to the treatment that we give to tax losses. And considering the financial and all those amounts that the certain areas needs to comply and to work, this limitation will not apply if those contracted to finance public infrastructure works for those of other projects in the extraction industry for petroleum, oil, gas, or whatever, or for the generation, transmission, or storage of electricity or water. The next slide. And here's your site, Francisco.
Yes, so in Brazil, first of all, when we talk about interest, we need to explain one hybrid instrument that is foreseen in the Brazilian legislation, and that was created with the specific purpose of stimulating investments in equity in Brazil. So there is this hybrid instrument that allows the calculation of a specific return on the net equity invested in the company. And this return should be deductible for income tax purposes in Brazil. But for the corporate legislation, it will be treated as a normal dividend distributed. Brazil always tries to place its conditions in the protocol. So in the Mexican-Brazilian treaty, we do have a provision for the interest on net equity. And what I wanted to mention here is that the BEPS action plan for report, it brought a specific example of hybrid instruments all over the world, and it mentioned the interest on net equity. So what we need to bear in mind is that it is still a valid instrument, but it is always being reviewed under Brazilian legislation, and many people consider that at some point it could be revoked. So please, the next slide. Regarding interest deductibility, we do have our fin capitalization rules, like our transfer pricing rules, the fin cap rules. They have very objective debt to equity ratios. So it is going to be 2-for-1 for regular debt, or 30% of the equity limitation in case of privileged tax regimes or tax havens. The thin capitalization rules, they should also apply when you have indirect debt, or there is the case of a guarantee granted by a related party. So our thin capitalization rules, they have been established in 2010, and there's not much jurisprudence regarding its application. Deductibility of interest in Brazil also, we also have the transfer pricing rules. So basically, when you have a loan with predetermined rates, you should follow as a benchmark the Brazilian sovereign bonds rates. So it's also very straightforward. When your debt is in the real currency, it should follow the same interest rates of the Brazilian sovereign bond issued in reais, or in dollars, should the debt be in dollar. We do have the application of the LIBOR as a floating rate whenever we have debt with floating rates as well. So the LIBOR should be the benchmark. And for all the cases, we should add 3.5% spread whenever you have an inbound loan. So whenever the Brazilian is paying interest abroad, or when Brazil is lending abroad, an outbound investment, then you have to the minimum rate you should charge should include a 2.5% spread. So this is how we compare our benchmark rates. So the next slide, please.
Well, now following up our next topic of the tax treatment of royalties and technical services concept, under the Mexican income tax law, and following also the same structure, it's stated that the payments of any kind of the temporary use or enjoyment of patents, certificates, trademarks, trade names, copyrights, drawings, or models shall be deemed as royalties. And here I want to point out, because this is very important, and considering the transactions made between Mexico and Brazil, the industrial, commercial, or scientific equipment which is granted for a temporary use or enjoyment will be deemed as royalties, and also those similar rights or property. These kind of payments of any kind received as a consideration for the use of, or the right to use all of the above, will be also considered as royalties. And here we have a very specific provision, which is not in line with the treaty. that states that the alienation of the goods or rights deemed as royalties, this is the temporary use or enjoyment of patents, industrial, commercial, any of these rights, will also be deemed as royalties if this alienation is conditioned to the productivity, the use or further disposition of the same goods or rights. Then making the comparison with the under the Brazilian tax law,
under Brazilian tax law, it's a very straightforward concept. We have Article 22 of Law 4506 of 64, and this concept is still valid. It's basically the use, fruition, or exploitation of rights. So we have the rights for vegetal resources, mineral resources, the use or exploitation of inventions, the exploitation of copyrights, except when perceived by the author or creator of the goods, or the late payment interest on any other compensation for the delay in payments for royalties. They should follow also the same nature.
And here in the highlights, I would like to explain a little bit how this may work under the Mexican perspective. And also as a way of example, let's consider that we have a Mexican tax resident that, I don't know, it's an airline, for example, which gets into an agreement with a Brazilian entity through which the lease of an airplane or a vessel or any equipment appointed as industrial, commercial, or scientific equipment, which will be exploited in Mexico, all those payments will be deemed as royalties, and as a consequence, such payments will be subject to tax in Mexico. And in the following slides, we will explain a little bit more of this withholding and all that stuff. But as a first of all,
Francisco,
we want also to mention, yes.
Just bear in mind that you have about 5 minutes left in your panel. Sorry for the pressure.
Oh, okay. Under the Mexican tax law, technical assistance is not considered within the royalties term. And in Brazil?
In Brazil, the definition goes broader than what we have normally in the double tax conventions. So basically, we have any type of services that would rely on technical or administrative assistance. So it's a broader concept.
Okay, and considering the time, I want to point out only that under the Mexican and Brazilian DTC, this alienation of the goods or rights is not comprised and then shall not be taxed as royalties by the Mexican government. And under paragraph 4 of Article 12 states that if the beneficial owner of the royalties is a resident of a contracting state who carries on business in the other contracting state, provisions of Article 7 or 14, as the case may be, shall apply. Here, I only want to point out that if Mexico cannot tax the alienation of goods or rights as royalties, the question would be if Mexico would be able to tax under any other concept, which, following the tax provisions applicable to foreign residents, I cannot find where this can, which provisions can be met, and then this alienation should not be taxable at all. Just to mention in the following slide of which are the withholding tax rates, Mexico has a general rule of 25% withholding tax on the gross amount of the royalties or technical assistance payments, and two specific reduced taxes regarding 1% withholding on royalties in connection with airplanes directly owned by the lessee in passenger or cargo transportation, or either the 5% on car, trailers, or semi-trailers, and a tax greater than the agreed under the tax treaty is a 35% withholding tax on royalties in exchange for the temporary use and enjoyment of patents or certificates of invention. And in comparison with the Brazilian tax law,
Yes, under Brazilian tax law, we have a general rule of 15% withholding income tax on the gross amount. The problem in Brazil is the discussion of the other taxes that are normally due when you have a Brazilian source paying. And those taxes, they are borne by the Brazilian entity that is paying for the intangibles or the technical assistance. In the case of intangibles, there wouldn't be the PIS and COFINS and the ISS, but when you have technical assistance payments, you would have as much as up as a 40% taxation on such payments. Brazil, as a policy, always wants to push services to be handled here. So whenever a Brazilian source needs to pay it, it is very complicated.
And just to remark that under Article 12, Paragraph 2, the maximum withholding tax has been agreed on a 15% withholding tax. However, going through the Article 5 of the protocol, which states that it can be a reduced withholding tax up to the minimum amount of the 10%, which here is the case since Brazil has agreed a 10% with the Israel tax treaty. All withholding taxes made under these transactions shall be made only up to that 10%. And in the following slides, we also wanted to remark how is the tax treatment of royalties payment deductions that where Mexican tax residents are entitled to deduct royalties considered as investments, which deductions have to be up to a 50% of the investment every tax year, and the entire deduction may be claimed if the benefit of said investment referred is materialized in the same year in which the expense was made. And the following is that a special deduction under the Mexican tax law has been provided, which is given for PEs consisting of the prohibition to deduct remittances made by the PE located in Mexico to the main office of the company or to another establishment of the company abroad, even if said remittances are made as royalties, professional fees, or similar payments. Moreover, the Mexican tax authorities have determined that royalties payments must be considered as non-deductible when they are paid to related parties resident abroad for the temporary use or enjoyment of intangible assets which had a Mexican origin and were previously owned by the taxpayer or any of its related parties resident in Mexico, and they were transferred to the party abroad without consideration or at a lower price than the market one. These under the ground that from the Mexican tax authorities considers that according to the according with this interpretation, the need for migration is not justified and therefore the payment are not considered as strictly necessary for the purposes of the taxpayer's activity, and then such payment deduction will be denied. And in the following slides, Francisco.
If you can, sorry, if you can start wrapping up your presentation, we do have a packed agenda. Sorry, Francisco. So if you want to give some conclusions on the Brazilian side and you want on the Mexican side, we do want to give time for Q&A.
Yes. Under Brazil, first of all, I want to say I'm sorry because I'm having a technical issue here. So I'm basically speaking cell phone and being filmed on my iPad. So some of during the presentation, I was showing my nails. So I'm sorry about that. But regarding royalties, the basic message that I wanted to pass on is that Brazil, under its international tax policy, is always going to push the payment for royalties to be treated under the article of, the payment for technical assistance and technical services to always be paid under the royalty article. So this is really important because whenever you have a protocol that says technical assistance should be included under the royalty article, Article 12, you are switching the applicable article from Article 7 to Article 12. So this is an issue. And going to my final slide, can you move on? Another one. So what I wanted to point out is the limitation on deductions for royalties that we have here in Brazil. Those limitations, they date back to 1958, and they are fixed. They don't follow the arm's length standard. Royalties there, they are explicitly excluded from the transfer pricing legislation. So basically, if you need to pay a royalty for a trademark, you are capped at 1% of the net revenue. And for the categories, it could go up to 5%. And there are cases, discussions. For example, we had the 3M case between Brazil and the US, where the company was assessed by the IRS for just charging 1% on the trademark. But here in Brazil, we have a limitation. We believe that in the future, if Brazil ascends to the OECD, as we are trying to, that limitation could be excluded from the internal legislation. But so far, we still have that, and it could be a problem for Mexican multinationals doing business in Brazil. So thank you, and with this, I wrap up my speech.
Thank you, Francisco. For the people in the audience, if you have any questions or comments with respect to the first panel, you need to raise your hand in the Zoom application. So please go ahead and do that if anyone has a comment or question. Also, the other panelists, Mariana and Eduardo, if you have any comment or questions with this panel, please go ahead and do them now.
Luis, take the time while there are no hands up. I found the anti-avoidance rule from Mexico very interesting in what concerns royalties, because it's limited to the intangible assets which were previously owned by a Mexican company, which seems a pretty better rule than the Brazilian one, which generally limits the deduction of payment of royalties, which is becoming much more complex in the context of the digital economy. So in this case, I believe, I don't know your daily practice with the Mexican rule, but maybe an anti-avoidance rule is better than our general one here, which dates from 58. And also know that on such scope of technical services that will escape from Article 7, Brazilian tax authorities try to argue that any service is a technical one. And this is really a problem because this creates a source taxation which would not exist otherwise. So we commonly deal with this problem as well.
Yeah, absolutely. We actually have we just had a GAR included in our tax legislation last year, a general one. So and we have the same problem with respect to services and the qualification as royalties with technical services by tax authorities. I don't know, Mariana, if you have another comment with respect to this panel.
No, and just I was just going to say what you were mentioning in connection with the same type of problem that we have, Eduardo, regarding the qualification of payments. There's always a discussion under Mexican law is if a payment qualifies as services, as technical assistance, or as royalties, because at the end of the day, in one case or the other, there is no, I mean, in the case of services and technical assistance under Mexican law and under our Mexico treaties, there's no taxation. But then if the authority reclassifies that and considers this to be technical assistance, then the payment would be qualified as a royalty, and that would be taxed. So I think as we can see, at least from what I've heard on this panel, it seems that we are facing the same type of problems where the Mexican tax authority and the Brazilian tax authorities are trying to always, of course, consider or qualify payments that on their rules that would make them taxable in their respective source countries, which is pretty much usual in countries that are importers of capital as our countries, that authorities will always take the source country position, no?
Yeah.
It's
Okay.
a little bit of insatisfaction with the general rule, which was established by OECD with the residents. So we try to push more and more to the exception, technical services, royalties, and similar ones.
Right. I think we can move on to the other panel, no?
Yeah, definitely. So the second panel, we have Ana Paula Saunders and Fernando Luján. Ana Paula, it's a tax planning Brazil manager at Vale, one of the biggest mining companies in the world. She has an international tax law degree from University of Leiden and a postgraduate degree in financial and tax law from Federal Fluminense University. And she's a co-founding member of the International Taxation Study Group in Brazil. And Fernando, it's a senior associate at Galicia Abogados in Mexico City. He has a master in tax law by Universidad Panamericana. He's a member of the Technical Committee on Emerging and Financial Technologies of the Institute of Accountants of Mexico. He has participated as a panelist on the taxation of digital economy in several forums, and he's a co-author of the book Todo Fiscal. So thank you, Fernando, and Ana Paula, please go ahead and start.
Thank you, Luis. Thank you, everybody. We'll try to be as quick as possible and try to skip the most obvious parts. Plus, I made a bet with Anna that I would deliver the presentation to her within 14 minutes, so I'm about to keep it. So we're going to talk about a little bit of control foreign corporations and how they relate to the tax treaties. This is not a new issue. However, there's been some developments in domestic legislation which make it relevant now. So we're going to start discussing the generals of control foreign corporation legislation and then go into the specifics of Mexican legislation and Brazilian legislation. CFC is an anti-abuse rule. It is designed to avoid tax deferral and tax avoidance through base companies in tax havens, basically shifting income from a high tax jurisdiction into a low tax jurisdiction in order to avoid triggering the high tax in the residence of the shareholder. So income of the CFC is taxed in the hands of the shareholders, even though the CFC has not made any actual distribution of dividends, and despite the fact that the CFC is a separate entity for tax and even legal purposes. So the CFC allows for current taxation of the shareholder on the income received by its CFC. And this is typically done by including in the taxable income of the resident shareholder a portion of the income received by the subsidiary CFC. Luis, can you go to the next slide, please? Thank you. Being an anti-abuse measure, it is also subject to certain exemptions where no abuse is deemed to take place. As a general rule, in most countries, there are 3 basic exemptions to the application of CFC. The first one relates to the ownership percentage of the shareholder. If the shareholder does not have enough control over the CFC, then no abuse is deemed to take place, and therefore CFC is no longer applicable. There are also some exceptions related to the activities performed by the CFC. If the CFC performs an active trade or business in its own country, then it is deemed that the CFC is not set off for abusive purposes, and therefore CFC taxation is not triggered. And the last one, which is the most important for Mexico at least, is the lack of sufficient taxation. So basically, if you have a CFC which is subject to a tax that is similar to the tax that would be levied on the shareholder in its residence jurisdiction, then no abuse actually is taking place, and the CFC taxation is generally not applicable. Luis, can you go? Thank you. Just as a general background, the first country to introduce CFC legislation was the US. The US enacted this in 1962 as part of the sub-paragraph rules, which are actually still in force. The US was later followed by Canada, West Germany, and Japan, also in the 1970s. And a series of other countries followed on in the 1980s and 1990s. Mexico introduced the first set of CFC legislation into its law in 1997. Mexican legislation first followed a blacklist approach in which it simply listed the jurisdictions which were deemed as tax havens, subject to CFC taxation. But later on in 2005, it was substituted by an effective tax rate test, thank you, in which a CFC is deemed to occur for Mexican tax purposes if the tax paid abroad, the effective tax rate paid abroad, is 75% or lower than the tax that would have been levied on the Mexican shareholder, either it is being a corporation or as individual as applicable. There are also some exemptions. There is an exemption concerning the lack of effective control, which was reformed in 2020 to align with the BEPS Action 3 recommendations. Now Mexico establishes that the exemption and control will apply only if an economic and legal test is met. We used to have a very laxative rule concerning the ownership percentage of the subsidiary or the control on the administration, which was easily avoided. So now we have more robust definition of effective control. We also have an exemption concerning the active trade or business of the CFC, in which no CFC taxation will be activated if the active income of the CFC is at least 80% of the total income in that jurisdiction. And there are other exemptions which apply to certain industries, such as finance. Luis, can you go ahead? Thank you. So, okay, here it is, the main substance of our presentation, the question we have for you, the carnitas, we call it in Mexico. Does CFC legislation go against tax treaties? This is an old debate. This is as old as CFC legislation. It has been subject to heavy debate, and case law in different jurisdictions has not been consistent. We will take a look at some representative cases in some key jurisdictions. And the dispute primarily concerns whether CFC taxation should be considered contrary to tax treaties that include a provision similar to Article 7, Paragraph 1 of the OECD Model Tax Convention. This also applies for the UN Tax Convention. And here's what we were trying to explain. If you take a look at Article 7, business profits of most treaties, what you have is a restriction in which profits of an enterprise of a contracting state can only be taxed in that state, being the residence jurisdiction. And the key word here is only, because this seems, we always take a look at this Article 7 and view it from the position that it is protecting taxing of business profits at source, limiting the source state from not taxing those business profits and leaving that taxation powers to the residence jurisdiction. But let us stop here for a little bit, because what happens with CFC? What happens if we have CFC which would appear in appearance contrary to this? So why don't we take a look at the example we have on the right? We have a holding company which is established in state A. It has no permanent establishment in state B, but it does have a subsidiary in state B. That subsidiary receives business profits from its own operations and is subject to tax in state B under the normal taxation system in state B. However, and this is where it gets tricky, state A has CFC taxation rules. So under the CFC taxation rules of state A, Holdco will be liable to tax on the profits earned by the subsidiary in state B. Does this breach, and this is the question, Luis, can you go to the next slide? Thanks. The question here is, can state A tax the business profits of the subsidiary in state B by application of its CFC rules? Does this go against Article 7 of most of the treaties? This is a question that we are trying to approach here. There are two approaches to this and two different answers to this. Luis, can you go? Thanks. So we have the first approach. The first approach is that CFC legislation goes against what is established in Article 7 of most of the treaties. And this approach considers an objective interpretation of Article 7. Article 7, under this interpretation, grants exclusive rights of taxation over business profits of a resident company to the resident state. I'm 7 minutes into the presentation. I'm okay. Taxation of the same profits by the other contracting state per application of its own CFC rules would therefore breach Article 7. So if you stop here and think about it, this interpretation focuses on the business profits. If the business profits are generated in state B, then state B would be the only jurisdiction with taxation powers according to Article 7 of the treaty. Article 7 protects business profits earned by foreign companies, irrespective of the taxpayer who is being burdened by that taxes. And we will discuss this interpretation later on, but just as an introduction, there were some countries which took this position, at least in prior OECD model convention versions. Belgium, Luxembourg, and Switzerland used to have this position and used to make some reservations to the OECD model in this regard. And we also have a ruling by the French court, which we can explain now. Luis, can you go ahead, please? So let's talk a little bit about the case law in France. The French Supreme Administrative Court, in a ruling in 2002 regarding a French resident who had transferred income to a subsidiary, concluded that the France-Switzerland tax treaty, based on the OECD Model Tax Convention, prevented the application of the French CFC rules. And this is because Article 7 of the tax treaty divided the taxing right on business profits in a Swiss company to Switzerland. France had no way to tax that because, according to Article 7, business profits earned in one country can only be subject to tax in the resident state, which in this case, it was a Swiss company. So taxation rights pertain to Switzerland. The approach taken by the French court did not rely on the OECD commentary, which is different from what we will see in the next slides, because the OECD is taking the opposite approach, and we will discuss that in a moment. Luis, can you go ahead? So this is the contrary interpretation, which resulted in CFC being able to be applicable or be applied in the existence of an Article 7 in the treaty. So under this interpretation, Article 7 does not limit the state's rights to tax their own residents, right? So here, what the state A would say is that state A is taxing Holco, which is its own residents, and it's only doing so in reference to the business profits of the subsidiary. But state A is not taxing the subsidiary, it is taxing its own resident, which is Holco. I don't know if that is clear. So CFC taxation is levied on the parent company, which is in state A, not on the subsidiary, and therefore there is no breach to Article 7. Taxes levied by a contracting state, such as A in our example, may not be said to have been levied on profits of the company of the other contracting state, which is state B, if said profits have not been reduced. Here is a direct extract from the commentaries updated to 2017 of the OECD Model Tax Convention. And this is a more economic approach. What this says is that it is so clear that CFC taxation does not result in the subsidiary being taxed because the subsidiary is not actually paying for that tax resulting from CFC. It is not out of the pocket of the subsidiary to pay for that CFC taxation. The one who is paying for that CFC taxation is Holco, and since Holco is a resident of state A, then there is no breach to Article 7. This is the interpretation that is generally accepted by the OECD. We will see a precedent from Finland, and we will also see a precedent from Mexico in this regard. Luis, can you go ahead? Thank you. So I will simply say that this ruling by the Finnish court is relevant because it analyzed whether CFC breached the agreement or the treaty between Finland and Belgium in the light of the spirit and purpose of that tax treaty. And what the Finnish court concluded is that, okay, CFCs are anti-abuse rules, which are meant to avoid undue tax practices. And treaties not only are meant to avoid international double taxation, but also to eliminate tax avoidance. So if the purpose of the tax treaty is also to avoid tax or to eliminate tax avoidance, then CFC is in line with that spirit and therefore are applicable. Mexico, Luis, can you go ahead? Mexico, the Mexican Supreme Court ruled this in 2009 as part of the general challenge to the CFC rules that were enacted or reformed in Mexico in 2005. And what the Mexican Supreme Court did here, and it is very interesting, it took the subjective interpretation to CFC. And what the Mexican Supreme Court simply stated is that the Mexican CFC rules were not taxing foreign companies, they were taxing Mexican companies. And to that extent, given that the company that was being subject to tax was a Mexican company and the tax was Mexican, then Article 7 was met. Article 7, which established that only resident companies could resident jurisdictions could tax their own residents was being met, and that was the ruling by the Mexican court. And here is an important part of this. Over the span of 40 years, the OECD's approach on this has changed dramatically, and that makes sense because in the beginning there were very few countries which had CFC rules, starting with the US. So if you take a look at the 1977 OECD Model Tax Convention, the CFC rules were generally viewed as unacceptable and incompatible with the provisions of tax treaties. And the commentary stated that if a country wanted to apply its CFC rules, then that allowance had to be expressly established in the treaty. In the absence of an express provision, the CFC rules were not applicable. This changed over the years. In the 2000 version of the Model Tax Convention, we had a more open approach to CFC. CFC was allowed and accepted as compatible with the model, even in the absence of an express provision under substance over form principles. However, CFC must still had to comply with the general spirit of the treaties, and some countries still maintain the position that CFC in some specific cases could be in breach of Article 7, and then a case-by-case analysis was needed. Having said this, in the last update to the Model Tax Convention of the OECD in 2017, the OECD took the definitive approach that CFC can be applied regardless of Article 7. It is not in breach of Article 7, regardless of what the specific content of the CFC rule establishes. So the OECD basically gave an open letter to countries to apply their CFC taxation without breaching Article 7. And just to make sure that there were no doubts about the position of the OECD, a saving clause was included in Article 1, paragraph 3 of the Model Tax Convention. Luis, can you go ahead? So this saving clause is very much in line with what the US has been done from many years ago in its own treaties. And what this saving clause allows is for the residents, the contracting state to tax its own resident regardless or without affecting anything within the convention, except if it is expressly included in the limitative list that is established in the saving clause. And as you can see, Article 7, paragraph 1 is not included in this limitative list, and therefore what the OECD thinks is that with including this saving clause in the treaties, will finish the discussion on CFC in the sense that CFC does not breach Article 7. And with that, President, and being 60 minutes, I lost the bet. Anna, please go ahead. Thank you.
Anna, just before you start, a quick comment to the audience. Even if you don't see your microphone and video, they are both turned off, so don't worry. If you want to speak and comment, you would have to raise your hand in the Zoom app. That's it. Thank you, Anna. Go ahead.
Well, first of all, I would like to thank Gustavo Brigagão, Eduardo Muniz, and ABDF for organizing this event, as well as thanking my great friend, Francisco Moreira, who invited me to share this topic with you guys today, which is maybe my favorite one. And going straight to the point, it is also worth mentioning that I am mentioning rules in quotation marks a lot, because I particularly do believe that Brazil actually has this type of law. So having the thoughts that Fernando brought, the main thing to think is Brazil wants to tax the profits earned abroad, regardless of any district and in all cases. That's why I said Brazilian CFC rules. So the first question is, Brazil have a CFC nation indeed? Because what goals of having the CFC law is actually the allocation of it's from a high to a low tax jurisdiction, to limit the artificial deferral of tax, to prevent tax avoidance, to discourage the shifting of income and investments from one country to another, and actually to avoid no substance structures. So if you have something that we might question the substance, or if there is an artificial arrangement there, then the CFC rule comes to be enforced. But Brazil do not analyze that. It does not check these points that I have raised. For Brazil, everything is worth tax. So we have a law that was enacted in 2004. It was the law 12,973. It is basically the previous legislation that we had. Basically, Article 76 says, the controlling legal entity, which is resident in Brazil, needs to record the accounting result related to the profits or losses. This is a new thing that this new law came with, the possibility of use the losses earned by the direct subsidiary and its subsidiaries directly or indirectly, which are resident abroad. So it means that Brazil will tax all the subsidiaries that earn any amount, not here in Brazil, but around the world. Please go to the next slide. And one point to raise is, Brazil wants to be part of the OECD group. So how does the Brazilian CFC law, sorry for that, observe exactly what the OECD says? Fernando mentioned Article 7, and I am not going to repeat it again. Basically, Article 7 will allow Brazil the subsidiary only if it has a permanent establishment in Brazil. Can you please just mark in the slide, please?
Anna, can you turn off your camera? We're losing you a bit when you talk.
Thank you.
Thank you.
Maybe it's better now. I don't know.
Yeah, it's better.
So can you please go ahead with this slide? Yes. So this means that if the subsidiary earn any amount abroad, Brazil will tax. And not only the profits that are maybe attributable to the permanent establishment here in Brazil. Please go. So although we have this law, 12,973, that was stated in 2004, like I said, and it is almost the same provision that the new one, we had something very important to discuss. We have the most important case, and not only because I work in Vale, but because the amount related in this case is very high. Vale has many subsidiaries around the world, and in specifically this case, it is related to Belgium, Denmark, Luxembourg, and Bermudas. All these subsidiaries, of course, earn huge amounts in this jurisdiction. And Brazil, because of our law, wanted to tax everything abroad. Our Supreme Court, can you go please to the next slide? Our Supreme Court, when analyzing the law, not this new one, but the previous one, which I said is the same basically, decided that the law is okay. There is no need to contest it, which is also very strange, because the Supreme Court, when it was analyzing the constitutionality of the rule that basically has the same wording of the Article 76 that I read, defined that the Brazilian law is okay and that this wide taxation is possible. So it seems that the debate is over, right? Since our Supreme Court has put an end to this discussion. But that is not what happened. And that's why I brought Vale's case. Since the court that has the competence to judge the compatibility of the Brazilian law with the treaty signed by Brazil is not Supreme Court, but it is to the Superior Court of Justice, STJ. Therefore, the situation that we have is that although our domestic law was declared legal, the issue as a whole would be decided by another court, which is Superior Court of Justice. And analyzing that specific case of Fali, STJ decided that the treaties should be observed due to the fact that they do not allow Brazil to tax under Article 7, Vale case. The exception in this case was related to Bermudas, and not because Bermuda is a tax haven. It was only because there is no tax treaty signed with Brazil. There were also two other important decisions, Coamo and Embraco cases, ruled by Brazil Supreme Court, STF, which again, I have to repeat, decided that our domestic law can allow the taxation of profits earned abroad. So we have two situations. We have our, on quotation marks, because you're not seeing me anymore, we have our domestic CFC rule that allows the possibility to Brazil to tax everything earned abroad. But we have also STJ, our Superior Court of Justice, saying that, no, the treaties need to be respected. You sign them because you need to verify the provisions. And if there is no permanent establishment here in Brazil, Brazil cannot tax. So the conclusion is the law 2009-73 allows the taxation of profits earned abroad. Supreme Court said this is okay. But the Superior Court of Justice, it is the only one who has the competence to judge issues related to the treaties celebrated by Brazil. Can you please go? So the idea is that when STJ brought this decision is that Brazil needs to respect the tax treaties, especially Article 7, that defines that the country, meaning Brazil, of course, cannot tax. So bringing this idea, this law, named here CFC domestic law, to the Brazil and Mexico tax treaty, we have Decree 6000, which was published many years ago, 2006, and that contains the text of the bilateral income tax treaty signed by Brazil and Mexico. The treaty is aimed at preventing double tax imposition and double non-imposition, see the importance of BEPS, of income taxes in cross-border operations between the two countries. This is exactly what is written in the Brazilian Tax Authority's website. So we have Article 7 of the tax treaty, which follows the OECD Model Convention, meaning that a country may only tax the profit earned abroad if there is a PE in its territory. And the consequence is, first, if a Brazilian corporation, meaning the parent company, sets up a subsidiary in Mexico, the subsidiary company will be taxed in both states, even though there is no PE in Brazil. As mentioned, this happens due to the fact that the Brazilian law allows a worldwide or broad taxation. So if the taxpayer wants to avoid the situation, meaning paying in both states, it is necessary, unfortunately, to file a lawsuit. The first thing to think is, does it damage Brazil's image, especially with OECD? We want to be a part of the group, and our law is completely different of what OECD says. It's different from the commentaries written in the OECD Model Convention. So if you want to be a part of this group, should we change our law? And the second, and I talked with Fernando about this, is should Mexico, I don't want to use this word terminate, but maybe reevaluate the tax treaty that was celebrated with Brazil, the same thing that Germany did. As Francisco said in the beginning, he was talking about the technical services. And this is just a curiosity. Brazil wants to tax everything, as I mentioned before, and it has a provision that allows Brazil to retain some tax here, withholding tax, to payments made abroad. Germany has a different sort. And this was written in the tax treaty that Germany celebrates with Brazil. And again, Brazil was violating this tax treaty. So what Germany did, it says, I don't want to be part of this anymore. So I don't want to have a tax treaty with you anymore. And that this tax treaty was terminated. So if a subsidiary that is resident in Mexico earn profits in Mexico, it's going to be taxed here in Brazil. So maybe Mexican government can ask Brazil to change the law. I don't know, but it is something that we should think, and mainly Brazil should think about it. Can you please? And actually, to bring an important international case here, I know that I said that Vale case maybe is the most important one in Brazil, not only because of the amounts involved, but also because of the decision. That was a very favorable precedent to all the taxpayers. The ECJ, the European Court of Justice, has judged the Cadbury-Schweppes case. And it brought for the first time the concept of wholly artificial arrangements. Can you please just one more and one more? Thanks. In summary, this case, it is about the Cadbury-Schweppes subsidiaries resident in Ireland. Ireland has the CAT rate only 12.5%. It is a very low rate. Maybe it's considered tax haven in some other jurisdiction. And these subsidiaries earn profit in Ireland. And the UK tax authorities wanted to tax these profits like Brazil would do. And it tried to do this. I am not sure about the amount involved. I can check here later, but it's a very important precedent in the ECJ because it said, well, first of all the subsidiaries have the freedom of establishment. It means that I can establish it myself anywhere in the world. The ECJ analyzed the genuine economic activity that the subsidiaries had. It means that there was substance involved and no abuse. Exactly what I brought maybe in the first slide. The CFC rules want to avoid exactly the lack of substance and to prevent the abuse. So if there is nothing regarding any abuse, why the UK wants to tax? So in the end, the profits generated by S1 and S2 in Ireland were only taxed in a very low rate in Ireland. So this maybe should be observed by Brazil. Okay, I have a provision that allows a broad taxation. But if there is substance in the other jurisdiction, if there is no abuse, should I be able to tax the profits earned abroad? And I want to be member, like I said, of the OECD group. Can I bring the ECJ precedent to my jurisdiction? I would say yes. Can you please go to the other? So just to finalize that, I have read a very important article, and I can share, of course, with all later. It was written by Andrea Marcontonio, and she was analyzing exactly the tax treaty between Brazil and Mexico. And even though the new CFC regime in Brazil has very similarities with the Mexican CFC regime, As Fernando showed us, Mexico is one step ahead of Brazil regarding its CFC regime. As its law, it's more compatible with tax treaties in the light of the OECD Model Convention. The reason that I'm saying that is that the Mexican CFC regime appears, I'm not affirming that, to target more specifically abusive transactions. This is when it is clear that the taxpayer's intention is to defer or avoid taxation. So although Mexican law is closer to the provisions of the OECD Model Convention, CFC regimes and all the applications still have to be refined, in my opinion, in both Brazil and Mexico. Even though some improvements can be seen in both countries, there is still a long way to go for both to have a CFC regime that they maybe, how can I say that, be considered to be compatible with tax treaties in line with the Model Convention. This would require CFC regimes not to be applied broadly, like I said. Of course, it needs to be restricted to the abusive situations, which is not only in line with the OECD views, but also with the tax treaties that we have read some provisions here, preventing tax evasion and avoidance. So in my opinion, Brazil CFC rules on quotation marks again cannot be named as CFC rule because Brazil wants to tax everything. And I think that in order to change this situation, Brazil government needs to look at the international scenario because the decisions that I have seen in the past, I don't know, maybe my master was in 2013, so 7-8 years ago, all the decisions are related to, okay, I can tax profits on abroad unless there is abuse. And if Brazil wants to be part of the OECD, it needs to change our domestic legislation. So I will come back to Fernando because he has this question.
I think thank you so much for that, Anna, because that is very in line with what I'm about to say as a matter of conclusion. We have some legal precedents which may make a clear distinction on the need for CFC rules to be exclusively applied where abuse takes place, as you mentioned. So what happens when CFC rules are applied in respective of the presence of abuse or not? And we have in Mexico, starting from 2020, a new system. We used to have the same system for opaque entities and also for transparent entities and partnerships in which a Mexican investor or shareholder participated, but that is no longer the case from 2020. And now we have current taxation for Mexicans participating in transparent entities and in non-vehicles without legal personality. And this is a way to conclude. The question has to be asked. Can taxpayers challenge Mexican taxation of business profits of a hybrid entity, let's say in Brazil, under Article 4B? Let's say that there's an entity which is deemed as opaque for tax purposes in Brazil, but is deemed as transparent for Mexican purposes. The Mexican taxpayer would be obligated to make a recognition under this new system of CFC. It's not CFC, but let's say it's CFC. Is this in line with Article 7? Even though Article 4B of the Mexican tax law provides no exemption, there is no exemption concerning control. There is no exemption concerning active trade or business. The Brazilian entity could be subject to the highest tax rate in Brazil, and that would be of no difference to the Mexican tax legislation. And just as a more general question, we have the position of the OECD from 2017, in which CFC can be applied in any case, regardless of the specific terms of CFC. Does this mean that resident states can have full taxation powers over foreign business profits under the cover of CFC taxation, regardless of specific terms? Is that what we end up having? And I'm just, as a conclusion, we have the paragraph to the right, which was within the commentaries to the OECD Model Tax Convention up to 2000. This was repealed in 2002. And this was the last case in which some rationality to the application of CFC was established in the commentary. This was unfortunately repealed. So it is worth taking a look at countries such as Brazil and Mexico, which have a treaty which could be covered by the previous commentaries, and analyze whether challenge is still possible based on Article 7.
Okay.
Okay.
Thank you very much, Ana, Ana Paula and Fernando. We're running a bit short of in time, so I'll see if anyone in the audience has a question. Remember that you need to raise your hand using the Zoom app. I actually can't see if anyone is raising the hand. Can you see that, Eduardo? Or
yes, Luis. No, for now not.
No. Okay. So if you agree, Mariana and Eduardo, we can go ahead and start with the third panel, and then we'll see if we have time for final comments.
Great.
Okay. Okay. So for the next panel, we have Leonardo Pignatari and Diego Lopez. Leonardo is a master's student of tax law at the University of Sao Paulo, supervised by Professor Luis Eduardo Schueri. He's a postgraduate in international law and Brazilian tax law at the Brazilian Institute of Tax Law, and has a bachelor in law at the University of Sao Paulo, and he's a tax lawyer in Sao Paulo. Diego Lopez has more than 8 years of experience in both domestic and international tax advisory services. Diego's main experience includes assistance to foreign companies in evaluating the expansion of business activities into Mexico, corporate restructurings, M&A transactions, and value chain transformation projects. Thank you, Leonardo and Diego. Please go ahead and start.
Great. Thank you, Luis. And thank you, Mariana, for the invitation to participate in this joint session, as well as our colleagues in Brazil. Well, as you can see from the slide on your screen, Leonardo and I decided to talk and discuss in connection with the tax treatment that should be applicable, or that should result applicable under the local law in Mexico and in Brazil, when a foreign resident entity or natural person transfers equity interests or shares issued by a local resident company. During our participation, we will discuss how these both countries, Brazil and Mexico, tax capital gain income obtained with a source of wealth located in its national territory. After discussing these local tax consequences, what we will try to do is to talk about the benefits on the double tax agreement that Mexico and Brazil could grant to the taxpayers, if any. And we will try to explain and to go on a couple of examples on indirect transaction between both countries. Well, on the Mexican side, it is important for you to know, probably our colleagues in Mexico, they already know, but our colleagues in Brazil, it is interesting at least to know that Mexican income tax law, according to the Mexican income tax law, when referring to the sale of shares of securities, Mexico considers that the source of wealth is located in national territory when the transaction, when happens two main scenarios. Mexico tax capital gains on two different scenarios. The first one is when the person issuing the shares or the securities to be alienated or transferred is resident in Mexico. This is direct transfers. Just for the fact that the shares to be sold or to be transferred are issued or were issued by a Mexican company, Mexico has a possibility to tax those transactions, those transactions made by a foreign resident. And the other possibility is when the book value of the shares of securities to be sold derived directly or indirectly from more than 50% of real estate located in Mexico. This is real estate. And this is indirect transfers. On the scenario one, direct transfers, the general rule in Mexico is to tax the transaction with a 25% over the full price with no deduction. This is 25% over the price agreed on between the parties, between the acquirer and the seller, and there is no allowed to make any deduction. Under this general rule, the resulting tax should be withheld and remitted to the Mexican tax authorities by the acquirer if the acquirer is resident in Mexico or resident abroad with a PE in Mexico. Those are the two possibilities when the acquirer is obliged to withhold and to remit the tax to the Mexican tax authorities. If that is not the case, if it's the case that the acquirer is not a Mexican resident or is not a resident abroad with a PE in Mexico, then the seller will be the obliged to pay the income tax in Mexico. However, even though that this is something that it is written on the Mexican law, that the seller will be obliged to come to Mexico to pay the tax, there is a impossibility manner to do that since two main characteristics. The first one is that a foreign seller is impossibility to file a tax return without tax ID in Mexico. For a tax resident abroad to obtain a tax ID in Mexico it's almost impossible, at least without any further consequences. What the Mexican tax authorities would understand when a foreign resident is trying to obtain a tax ID is that he will pay income tax in Mexico from the source of wealth located in Mexico, which is not the case if the seller is only paying taxes for one shot time, for one transaction, which could be the sale of the shares. And the other impossibility is that the seller does not have a bank account in Mexico from which he could be paid, or the seller could pay or transfer the funds to the Mexican tax authorities. What we normally do in these scenarios in Mexico is to suggest to the seller to appoint a legal representative in Mexico with a tax ID or with a bank account to pay on his own name or on behalf of the resident abroad the income that would result from applying the 25% over the full price with no deductions. However, as I said, this is a practical solution not provided on the Mexican law. This is more a practical solution, but the Mexican tax authorities on the law does not contemplate this scenario. Considering that the 25% over the full price without any deduction is normally very costly for a taxpayer who is selling its shares, its participation on a Mexican company, the Mexican tax authorities on the Mexican law have provided an alternative to tax these transactions with a 35% over the net gain obtained. This is the amount resulting by subtracting from the price agreed the tax basis, the tax cost of the shares of securities to be transferred, which also may result on a loss, on a tax loss, and no further income tax to be paid in Mexico. However, as this is an alternative in Mexico, this is not the general rule. This alternative, in order to apply for this alternative, we need, or the seller needs to comply with certain requirements. The first and probably the most important requirement is that the seller should not be resident on a preferential tax regime or in a jurisdiction with a territorial tax regime. For the case at hand in Brazil, I understand that the corporate tax in Brazil is 35%, which is not a preferential tax regime or jurisdiction, and Brazil does not have a territorial tax regime. So any transaction that would comply with this, which would be the case of all Brazilian sellers, would be complying with this first requirement. The second requirement is that the seller, the Brazilian seller in this case, must appoint a legal representative in Mexico for purpose of this transaction. The legal representative should be a resident in Mexico or a resident abroad with a PE in Mexico in the case of an entity. And the legal representative could be an individual or a natural person. Normally, what we see in Mexico is that when it comes on reorganization transactions, they decide to appoint the target company by itself to being as the legal representative. And the third requirement is that the CPA and the a certified public accountant authorized by the Mexican tax authorities must file a tax opinion, a dictamen fiscal, before the Mexican tax authorities on the transaction through which such CPA validates the tax basis of the shares or securities to be sold, to be transferred, and the gain or loss obtained by the foreign seller. If those three requirements are complied with in a timely manner, then the foreign seller could apply to a 35% over the net gain to be obtained on the transaction. It is important, or at least for me, it is important also to mention that this tax opinion that should be prepared and filed by the CPA is kind of an audit of the Mexican company. He has to ensure that all the tax returns, the annual tax returns of the company has been placed in order and in accordance with the Mexican law. So this is a very hard work, and it leaves a couple of weeks to be prepared and to be ready. So this is something to keep in mind. We've finished with the direct transfers. On the scenario DOS, on the possibilities that Mexico has to tax transactions, this is on indirect transfers. The general rule is that Mexico will be in position to tax the transaction when, as I said, when the book value of the shares of securities to be sold derive directly or indirectly for more than 50% of real estate located in national territory in Mexico. Therefore, if a resident abroad, in this case Brazil, sells indirectly the shares of Mexico, and those shares are mainly represented by, or the book value of those shares are mainly represented by immovable property in Mexico, then Mexico has the possibility to tax such transaction as well, and the tax will be the same as the general rule, 25% over the total amount of the transaction, or 35% of the net gain if the seller complies with all the requirements mentioned before. For these purposes, it's important to mention that the Mexican tax provisions do not define the term of book value. So the provisions of the applicable accounting standards should be analyzed. Lastly, we should keep in mind that Mexico has enforced, as of January of this year, an anti-abuse provision allowing to the Mexican tax authorities to disregard the tax effects on transactions. So on indirect transfers who could be free of tax, it is important to make sure that a business rationale must exist on these transactions. Luis, can you move on? Thank you. And additional considerations for capital gains in Mexico is the Mexican.
So, sorry, you have about 5 minutes left on the Mexican side. Sorry.
Yeah. On the final side of the additional considerations, it is important to mention that the treat that Mexico has to these capital gains, it also includes the usufruct or the use of shares of securities issued by a Mexican resident. This is not only the transfer or the alienation. This is also when a company grants the usufruct or the use of shares, it will be considered as well as alienation of shares. The transfer of the usufructory rights related to the sold shares are also considered to be as a transfer of shares, or any legal act in which the right to receive the income from the shares of securities is transferred partly or totally. It is also important to mention that if, as a common standard, if the transaction is carried out between related parties, the transaction must be agreed under fair market value. And the disposition, the Mexican legislation contemplates a deferral authorization between corporates, entities of the same corporate group. So please keep in mind that possibility too. So the next slides, we will discuss the Brazilian tax consequences. Leo?
Good evening, everyone. It is a great pleasure to be part of this joint event between Brazil and Mexico. First of all, I'd like to thank you everyone involved in putting together this seminar, especially our in Brazil chair, Eduardo Muniz, for the invitation. Now I have a huge challenge because I'm going to speak after all the amazing presentations that my Mexican and Brazilian colleagues have given. But I'm going to do my best to present the Brazilian tax treatment of capital gains. My presentation is basically divided into 4 parts. The first one regards the tax treatment of capital gains for individuals. Second, for legal entities. Third, for non-residents. And finally, if we have time, I'm going to discuss 2 examples in the Brazil-Mexico tax treaty. Regarding the tax treatment of capital gains for individuals, there are 3 main transactions that trigger the taxation of capital gains in Brazil. First, the alienation of assets or rights, or assignment or promise of assignment of rights. Second, the transfer to heirs and devices in succession causa mortis. And third, alienation of assets or rights and liquidation or redemption of financial investments. From 2017, law number 13259 from 2016 established new tax rates and thresholds for the taxation of capital gains in the case of individuals. This provision is derived from a provisional presidential decree, which is number 692 from 2015, which fixed bigger tax rates and monetary thresholds, changed later by the National Congress. Note in the table of the slide that we have high thresholds, 5 million, 5 to 10 million, 10 million to 30 million reais, and amounts bigger than 30 million. Personally, I'm not very close to the first threshold, but Brazil decided in 2017 to change its tax rates and its monetary thresholds. Please, the next slide, Luis. And it is important to mention that the taxation of capital gains for individuals is definitive, which means that capital gain will not be included in the annual tax return of the individual. Also, the payment must be made until the last working day of the month following the one in which the earnings are perceived. And at this point, it's important to say that the Brazilian legislator has adopted a cash-based method for individuals. Moreover, the Brazilian legislation is very sparse and provides different types of exemptions. Here I bring 4 of them, which are frequently applied in our reality. We have the sale of goods and rights of small value, the sale of the only property owned by the holder whose sale value is up to 440,000 reais, the sale of residential properties provided the seller within 180 days from the conclusion of the contract applies the proceeds from the sale of residential properties located in the country, and finally, net gains from operation in the stock market, which has a monetary threshold of 20,000 reais. Due to the time, I'm not going to deepen these exemptions, but it's worth mentioning because they are very, especially the last 2, very frequently in our reality. And there are also some special regimes, such as financial investments, which demands a source taxation, whose responsibility is of normally the brokers or financial institutions. we have a 15% rate, a general rate, and 20% for day trade operations. Or, depending on the type of the investment, the Brazilian legislation provides regressive rates, 15% to 22.5%, depending on the length of your financial application. What I mean, the longer you hold your application, the lower will be your tax rate. Next slide, please. Now moving to my second part concerning the taxation of capital gains for legal entities, it encompasses two main transactions. First one, results of sale of assets classified in non-current assets, investments, fixed assets, intangibles. And second, transactions that imply the sale in any capacity of assets or rights or assignment or promise of rights. And how to calculate the capital gains for legal entities. Basically, capital gains is considered a non-operating result for the legal entity. And will be the difference in the asset or right which has been sold, expropriate, write-off, and its book value. So basically we have alienation value minus book value equals capital gain. That's the equation for capital gains in legal entities case. However, the Brazilian law has some special features depending on the tax regime to which the company is subject. A taxable profit regime or the presumptive profit regime. In the taxable profit regime case, on the sale of assets or rights classified in non-current assets, capital gain will be added to the non-operating result of the legal entity. And also, this amount of capital gain will not be included in the tax base for PIS/COFINS, which are two social contributions that the Brazilian law provides. Next slide, please, Luis. On the other hand, the taxation in the presumptive profit regime, capital gains correspond to the positive difference between the alienation value and the book costs in the case of the alienation of assets classified as non-current assets. And for making myself clear, I have come up with a simple example. Imagine that a legal entity A had a result for the provisions of service of a total 350,000 reais. And in the same period, this company sold a non-current asset for the amount of 50,000 reais with the following data. First, the acquisition value of the same asset was 100,000 reais, minus the accumulated depreciation that shall be deducted, we have a book value of 30,000 reais. The alienation value of 50,000 reais, we have capital gain of 20,000 reais. This is the simple equation of the taxation of capital gains in the presumptive profit regime. And sum up all the math that I made in this example in the table in the slide, and hopefully I have made the calculation right. Under the presumptive profit regime, we have a tax burden approximately of 6.73% on sales value, which includes the Brazilian corporate income tax, the Brazilian social contribution on net profits, and also PIS/COFINS, which are also social contributions. This 6.73% on sales value is in the case of alienation of current assets. In the case of alienation of non-current assets, we have a taxation of 15% plus 10% of Brazilian corporate income tax plus 90%. And here we have the famous 34% Brazilian corporate income tax rate. And there is a lot, here is important to mention that in Brazil, there is a lot of controversy regarding the reclassification of assets. If you reclassify, the company reclassifies a non-current asset to a current asset only to get this kind of rate, the 6.73% rate on sales value, not on the capital gain. It's important to say that, but I'm going to leave it for further discussions. Luis, please. Now, the third part of my presentation regards the taxation of capital gains derived by non-residents. And capital gain derived by a non-resident is calculated and taxed exactly according to the rules applicable to Brazilian residents. For instance, Article 744 of the Brazilian Income Tax Act establishes that income, capital gains, and other earnings paid, credited, delivered, employed, or remitted by a source located in Brazil are subject to Brazilian withholding tax. Therefore, we have a source of payment rule. That's why Ana previously said that Brazil wants to tax everything, because everything that's related to Brazil, even if in a weak way, Brazil wants to tax. And concerning this point, it is interesting to mention that we have a very good discussion regarding the moment of withholding the tax. Tax authorities argue that it is the credit entry, and taxpayers obviously state that it is the maturity date. And some administrative and judicial decisions have already stated that it is taxed in the maturity date, going with the taxpayer's position. And in this sense, the same rates that I mentioned before, the slide before, the table before, are applied to non-residents with a slight difference. Non-residents of countries with favored taxation, for example, tax havens, are subject to a 25% rate. And here we come with another important question. Okay, we have a withholding tax in Brazil, a source of payment rule, but who is responsible for withholding and paying the tax? The acquirer, resident in Brazil, okay, he's resident in Brazil, we have a strong link. But if he's not a resident in Brazil, tax liability will fall on the agent or the attorney in fact of the acquirer or the transferor. And this is a strong debate that we had in Brazil for a long time. And only in 2017, the Brazilian tax authorities have positioned and said that the purchaser's agent, attorney in fact, in Brazil is responsible for withholding and paying tax of an operation totally connected with operations abroad. Please, Luis.
Leo, you have about 5 minutes left on your time.
Okay, thank you. And this fact has a great importance. We analyze this special provision. Article 26, law number 10833 from 2003, in its explanatory statement says that combating tax evasion by non-residents is one of its main purposes. So if the acquirer is a resident of Brazil and sells some asset for a non-resident, okay, we have a link with Brazil, the transfer is abroad, the acquirer in Brazil, and the clear responsibility for withholding and paying the tax is of the acquirer. And the connection factor, you have a source of production plus a source of payment. The problem we have here, it is a very interesting problem, a problematic one. It is the second part of this article, because both transferor and acquirer are abroad. So who is responsible? The contract is signed abroad, the payment is made abroad, the parties are abroad, and Brazil wants to tax it. How? Who is responsible for withholding this tax? Is there any connecting factor? And another question, could the agent, attorney in fact, access the benefits of the treaty since he is responsible according to Brazilian tax authorities for withholding the tax? Does it fulfill the subject scope of the tax treaty? And here we must remember Kees van Had 5 rules for applying a tax treaty. And basically, it's a very interesting question. I don't have an answer for it, but I believe it is very interesting. And therefore, there is a clear difficulty of supervision and collection. This second part, guys, reminds me of what Professor Gerd Hoffman, an ambassador of international tax law in Brazil, used to say. We all know that arm's length principle, which is commonly used for transfer pricing operations. But this second part of the Brazilian provision created a new principle, the at miles length principle, because the elements are so distant from the Brazilian territory, and Brazil still wants to tax, that Professor Gerd Hoffman was used to say that it established the at miles length principle and not the at arm's length principle. And please, Luis, coming to the end of my presentation, we have the clear example of an indirect transfer of shares. And it is a very controversial structure which has been challenged by the Brazilian tax authorities. Mainly, they use arguments such as economic substance, business purpose. However, the Brazilian National Congress has rejected the business purpose as a criterion for evaluating tax planning twice. So Brazilian Congress has rejected this important concept of business purpose and economic substance twice, but tax authorities still are trying to apply these foreigner concepts and issuing tax assessments without any disclaimer. And here is important to remind that Brazil does not have a general rentability rule. Different from Mexico, Brazil has not created a GAR. Brazil does not have a GAR, and still wants to apply a criterion clearly, expressly rejected by the National Congress. That's a huge problem that taxpayers in Brazil are facing. And Luis, I don't know if we have time left, but Diego and I came up with 2 quick examples of the application of Brazil and Mexico tax treaty.
Well, we're a bit over time, Leo. So if you want to just finish up with a conclusion with respect, or just pick an example.
Sure.
Thanks.
Sure. Just 1 minute. Our example is very simple. Ronaldo is a famous footballer resident in Monaco, and this structure is an indirect transfer of shares. The question here is that, from a Mexican perspective, it is a direct sale of shares taxable according to the Mexican domestic legislation. And from a Brazilian perspective, it is an indirect transfer of shares. So here we have an interesting conflict, a source-by-source conflict, which is not solved by the OECD new approach and by the Article 23 of Brazilian-Mexican tax treaty. So we have a clear example of double taxation. For Mexico, it is a direct sale of shares, clearly taxable, and for Brazil, it is an indirect sale of shares, also taxed here. And Article 13 of our treaty does not solve this problem because there is no single reference to alienation of movable property. So I believe we have many questions from this case, and due to the time, I'm gonna leave the floor. And thank you very much for your attention, and I'm available for answering any questions from the audience. Thank you very much.
Thank you, Leonardo. And sorry, guys, for the amount of time that we had. I know we could take at least 2 hours for each panel. Also, nobody wants to be 6 hours sitting on the chair without a break. So I guess I'm going to open the floor for some. Let's see if there are any Q&A from the audience. Remember that you have to raise your hand through the Zoom system if you want to make a comment. If Eduardo or Mariana see a hand raised, please let me know.
No, Luis, I can't see any.
No? So then I don't know, Eduardo or Mariana, do you have any comments before we finish up the presentation?
Luis, just a very quick comment on capital gains in Brazil, because now we are facing a problem that real has lost value in comparison to other currencies. And commonly, we face a problem of the situation in which a non-resident sell an asset located in Brazil for the same cost in foreign currency. But in Brazil, he has a substantial gain. And this is really a dispute here on whether this gain should be taxed in Brazil, because in reais, Brazilian currency, he has a gain, but sometimes in foreign currency, he actually has a loss. And taxpayers argue that there is no income in this situation, because a non-resident sometimes is suffering a loss or have no gain at all. But this is really a challenging topic in Brazil.
Okay.
Interesting. I think, I mean, from a Mexican standpoint, what I was able to see in comparison with the Brazilian regime on capital gains, it's interesting to see that we have exactly the same issue in Mexico in connection with the transfer of Mexican companies between non-Mexican tax residents. As in the case of Brazil, there is not really a mechanism foreseen under the Mexican law to make the payment. What we always do is we suggest clients to make the payment by appointing a legal representative and conducting the payment through a withholding conducted by the legal representative. But in reality, there is no mechanism and there is no specific controls by the Mexican authority in connection with that. Something that is also interesting in connection with indirect transfers is that we see this problem a lot in other Latin American countries. In the case of Mexico, indirect transfers are taxed only when they are related with real estate shares. But as I was able to understand, in Brazil, it's regardless of whether it's real estate or non-real estate shares, indirect transfers are always taxable. So we always see this problem. This is a problem not only in Brazil. I think I have seen this in Peru and in other jurisdictions. It's exactly the same problem, and then we have to figure out other ways of doing the exit, because otherwise we will have this double sourcing conflict that is not resolved by tax treaties. So those would be my only commentaries to this presentation. Unfortunately, I don't have time to make comments to the other presentation, which was also great on the CFC rules.
Thank you, Mariana and Eduardo. I guess we can finish up at 15 minutes after the hour. So if anybody else has a comment, also from the panelists, we can wrap up. If there's no comment.
Oh. There are some comments on the chat. Enriquez Perez, Colorado.
Oh, I can't see the chat. Marina, can you read the?
Well, yeah, I mean, he made one comment on the Cadbury Schweppes case described by Ana Paula, that he was mentioning that Cadbury is the origin of the 2020 Mexican rule on payments made to tax havens. I agree with Enrique's commentary, and another was a joke in connection with the best player in the world regarding your example, Leonardo, that since you don't have any Argentinian audience, you can say that.
You never know. You never know. This is live on YouTube.
Yeah, this is on YouTube, Enrique, so be careful.
Okay.
Yeah, those are the only two comments. I think
hopefully we do not have any Portuguese from the audience, because we would ask who's Ronaldo. Brazilian one or the Portuguese one?
Yeah.
Exactly.
So I think, Marina, we can wrap up. I would like again to say thank you to Claudia Sutter for being here. We know it's late over there in Switzerland, so thank you again, Claudia, for staying
and she's bearing with us, which is impressive. Thank you very much, Claudia. Thank you always for your kind support on our sessions.
And thank you for organizing this. It was truly interesting, I must admit. And I think it's also worth encouraging what you're doing to bring together the Yin community, and despite borders and despite not being able to meet. So this is a great forum that you've created.
Thank you, Claudia. And we hope that we can meet everybody soon in Germany or in Cancun in 2022. Again, thank you to all the panelists for your great effort. You put a great presentation in a very short amount of time. So thank you again, and happy holidays to everyone, and see you next year.
Holidays, everyone.
Thank
Congratulations.
you very much. Good holidays.
Thank you.
Thank you.
Bye.
Take care.
Bye. Thank you.
Thank you. Bye.
Bye.